Hello everyone, my name is Anjani Kumar Khetan. I'm based out of Bangalore in India. In this concluding part of the video series on how to deal with changes in decommissioning liabilities, we will now look at a comprehensive case study and will take you through what happens if there is a change in the decommissioning liability in scenario where the asset is being held under the revaluation model, how the accounting happens. Now, as you are aware, we have already done 3 videos on this particular series. So what I will do in the description of this video, I will have the links of the other 3 videos as well, so that if you have not seen the other videos, it is very important that you see that, because this is in the sequence of those discussions. So as part of this particular video, what we will look at is just the comprehensive case study. But before that, just one simple slide. We have already talked about in the 3rd video last week that paragraph 6 of IFRIC 1 and or Appendix A to Ind AS 16 from an Ind AS perspective, it requires you that the change in decommissioning liability wherein the asset is being held under the revaluation model is the dependent upon what has happened in the prior period. And I have given you this case study in the earlier video. We will apply the same concept in the comprehensive case study as well. I just wanted to bring in this particular slide just so that you have a reference point of what we are going to use in our case study. So let's look at the case study. What happens in this case? So consider a scenario similar to what we have seen in the earlier videos as well. You have a nuclear power plant and you have a related decommissioning liability. So you have a nuclear power plant and the related decommissioning liability. The plant started operating from 1st April 2019, has a life of 40 years, and SLM method of depreciation is being followed. Now, with this fact pattern, it says that the case study says the initial cost of the plant, nuclear power plant, is 120 million. And we have seen, right, that at the time of initial recognition, what is your cost of PP&E? Your cost of PP&E per se plus present value of the decommissioning liability, which is going to be settled in this case at the end of 40th year. Sum total of these two numbers should be the initial recognition. So that's exactly what paragraph 3 tells you here. Paragraph 3 tells you the initial cost of the nuclear power plant was 120 million, consisting of 2 parts. 110 million is the cost per se, and 10 million is the present value of the decommissioning liability. How it is? Let's see here. So it says the total cost was 120 million, including decommissioning liability of 10 million. And how this 10 million was arrived at? 10 million representing present value of 70.40 million, which is estimated to be payable at the end of the 40th year, discounted at 5% discount rate. Thereby meaning, simply stated, what it says, you have an obligation at the end of the 40th year of 70.40 million. This discounted at the rate of 5%, 1.05 to the power 40. If you solve this, this will give you 10 million. So therefore, present value of this number, which is 10 million, is something which you need to include as part of the initial cost. And therefore, your total initial cost will be 120 million, consisting of 110 plus 110 plus 10 million. Now, what happens at the end of year number 3? You started on 1st of April 2019. At the end of 3 years, point number 4 says, at the end of 3 years, on 31st of March 2022, the entity has obtained the fair valuation of this asset is under the nuclear power plant is 115 million. See it very carefully. What does it say? That valuation was 115 million, but this 115 million of the value did not include the decommissioning liability of 11.58 million. Why 11.58? This is, if you remember, in the last video I said The unwinding effect, it cannot be ignored. Okay, that also need to be considered. I'll explain it to you how this 11.58 million is being computed, and this is the valuation obtained from the market. See, what happens? You had a liability of the present value of the liability you recorded at 10 million. At what discount rate? 5%. And you have 3 years which have gone by. Right? So for each year, you will have unwinding of this interest at the rate of 5%. And therefore, if I'll show you the next slide also, the computation, this 10 million will become 11.58 at 5%. Even if there is no change in the present value of the decommissioning liability, this balance will change because of the unwinding effect. I'll explain this to you in the next slide. Now, what happens? If you look at this point number 4, you should not get confused by 115. The asset need to be carried at the end of this year as a sum total of this plus this. Because the PP&E has to be carried consisting of both the equipment or the PP&E, in this case, the nuclear power plant, plus the value, the carrying amount of the decommissioning liability. So you need to consider both. You can't just take the value of this 115. And therefore, total amount which need to be carried in the books at the end of the third year will be 126.58 million. Let's look at what the next point says. At the end, let's read point number 5 and 6 together. It says at the end of the fourth year, one year later, at the end of fourth year, as of 31st of March 2023, the entity now estimates that this amount of 115 million, or no, not this, okay, what it says, the present value of the decommissioning liability has decreased by 5 million. So it does not say what is your liability balance at the end of the fourth year. It says at the end of the fourth year, whatever your liability balance would have been, that has been reduced by 5 million. Apart from that, so there are two effects which are happening at the end of the fourth year. One, there is a reduction of 5 million in the liability, and on top of that, this 115 million has now become 107 million. So there is a revaluation on the asset per se. Revalued amount of the power plant is 107 million, and also there is a reduction in the decommissioning liability to the extent of 5 million. So there are two impacts which are happening at this point of time on the fourth year. Of course, the asset has the ultimate life of 40 years. Now, in this case, the question is, how should entity record the change in the decommissioning liability which is happening here? And rather, let us see the entire life cycle till end of your fourth year, that is 31st of March 2023, how the accounting has to happen. Let us see in the next few slides. So, I've just brought forward the timelines. So, we know in this case, initial recognition was at 120 million. What is 120 million? Is 110 plus 10. This is what 120 million was the initial capitalization of the PP&E. SLM method, 40 years. So 120 divided by 40 will give you annual depreciation of 3 million. So in 3-year period, first 3 years, 120 each year, you will record a depreciation of 3 million each. That means 9,333 is your total depreciation in the first 3 years. And therefore, the carrying amount, if nothing would have happened, of the PP&E, including that decommissioning liability, would have been 111 million. What is 111? 120 minus 3 minus 3 minus 3. Right. This is on the asset side. What about the liability? Your decommissioning liability present value was 10 million. At 5%, now you have to do the unwinding. So 5% of this 10 million, 0.5 million, would be your interest unwinding. And therefore, the carrying amount of the liability at the end of year number 1 will be 10 million plus 0.5, 10.5. This 10.5 will become the opening liability for year number 2. Now you will record 5% of this 10.5 million as the unwinding. And therefore, the liability that way at the end of the third year will become 11.58 million. This is the liability, which is as per the calculation if nothing would have happened. But then the case study tells you that there's a reduction of 5 million in the liability at this point in time. And also the value of the asset, excluding the decommissioning liability, has also changed. Let us see this. Let's bring those numbers here. So as I explained, in the first 3 years, you have a total depreciation of 9 million. You have a total interest unwinding of 1.58 million, sum total of these three numbers. And therefore, what happens? Your total revalued amount at the end of year number 3 is 115 million plus 11.5. 115 is the market. This number has come from market. If you see this case study, 115 is your market-based valuation, right? So at the end of year number 3, your total revalued amount, let me clear this, is 115 plus 11.58, but WDV is only 111 million. And therefore, you have a revaluation gain of 15.58 million, which is the difference between these two numbers. Accordingly, your opening WDV for the 4th year here. So at the end of year number 3, this is the gain. You will record the revaluation gain of 15.58, which is the difference between these two numbers, right? And then your opening WDV will be this carrying amount, okay? Will be increased by 15.58, which means we'll see that in the calculations in the next slide also. Now, what happens in this? Now you will, because there is a revaluation gain or to the extent of 15.58, you will record this journal entry. PP&E debit by 15.58, credit first time revaluation surplus in OCI. That is what you will record. So what is the effect of this? Your PP&E value will go up from 111. It will get increased to the extent of 15.58, and correspondingly you will have a revaluation surplus. Now going next. What happens in year number 4? In year number 4, now your opening PP&E will be 126.58. Why? Because you recorded the journal entry of the revaluation gain, and therefore now this we computed in the last slide that your opening PP&E will be 126.58. Now what happens? Now of the total 40 years, 3 years are already gone. You are in the 4th year. So this amount of the opening the WDV, this now need to be amortized and depreciated over 37 years. 3 years already gone of the total 40 years life. 3 years already gone. So you have only 37 more years to go, and therefore your depreciation charge will also will also change, because now your depreciation charge will be this number divided by 37. That will be your annual charge of depreciation based on this amount, right? Same way, if you look at from the liability perspective, your carrying amount of the liability is 11.58, which we saw in the previous slide. 11.58. This is the carrying amount of the liability. So you will start with that. So 11.58 will be your liability starting, and then 5% unwinding for the 4th year is 0.58, and therefore your liability balance at the end, closing decommissioning liability by regular schedule is 12.16. But then the problem says it has been reduced by 5 million. Okay, let us see all of these numbers on the timeline. So what happens in this case? Your depreciation charge for the 4th year, as I explained to you, will be 126.58, this number divided by 37 years. So now it will go up from 3 million in the first 3 years to 3.422 million for the 4th year. That is on the depreciation charge. Then your unwinding of the interest for the 4th year is 0.48. And now if you have a 5 million of a decrease in the decommissioning liability. So see here, your closing balance of the decommissioning liability at the end of the 4th year as computed is 12.16. And there is a reduction of 5 million. So therefore, what is the liability which you need to carry? You need to carry decommissioning liability at the end of the fourth year as 12.16 minus 5 million. That means A minus B. 7.16 should be your future carrying amount of the decommissioning liability. And therefore, to reduce this 5 million, you'll have to record this entry. What is the entry? In this case, you will reduce. So, because the liability is getting reduced, it's like a gain further which you are having. Therefore, you reduce your provision. And as we have seen in the earlier case studies and the videos as well, this gain will be recorded in OCI, revaluation surplus, not in P&L. Okay, so this effect will go into revaluation surplus. So the journal entry, this is the journal entry which you will record. Now, what happens at the end of year number 4? Now, your revalued amount is now 107, which you had 115 in the previous year. Now, it is 107, but this is again, just like it's a net amount. You need to add to this the 7.16 because your total carrying amount of the asset at the end of any period will consist of the PP&E charge per se plus the carrying amount of the decommissioning liability. Now, in this case, the carrying amount of the decommissioning liability is 7.16, which we computed here. So, the total amount which you need to carry at the end of this year is 107 million plus 7.16 million. Total should be some total of this, which is 114.16 million. This is the amount as it should be. But then, what is your WDV at the end of year number 4? The WDV of your PP&E at the end of year number 4 is 123.16. You need 114.16 million of the carrying amount, but you have only 123 16 is the WDV at the end of year number 4. Right? So in this case, there is a revaluation loss of 9 million. What is 9 million? Revalued amount is 114.16. Your asset is at a higher number, 123.16, and therefore you 114.16 revalued amount. This is the amount at which you need to carry. The asset is at a higher number of 123.16, and therefore you have a revaluation loss of 9 million, the difference of these two numbers. Now you have to do the accounting for this as well. Let's see. So now for this 9 million, what you will do, now you will record the reduction in the PP&E, of course, to the extent of 9 million. The question is where the debit will go. Now in this case, because you already have revaluation gain of 15.58 plus this revaluation gain of 5, total 20.58, and the loss is only 9, which is lower than that, the entire debit will go to OCI revaluation surplus. That is what we have seen as the principle in the earlier video and the earlier slides as well. So therefore, given this information, how your ledger balances will work out. So when you look at the PP&E, for all the 4 years, you started with 120. For the first 3 years, you will record depreciation of 3 million each. But then, at the end of the 3rd year, you record this increase or decrease revaluation gain, debit PP&E. So therefore, this is your revised number, which becomes your opening. Now your depreciation charge goes up. And then you are recording 9 million of the revaluation loss through your revaluation surplus. And therefore, your closing amount of the PP&E is 114.16. This is on the PP&E side. Now, let's look at on the decommissioning liability. Same, you started with 10 million. You have interest unwinding of these 3 for the first 3 years. This is your closing balance. This becomes opening. And then again, 5% of this. 5% of this number is your interest unwinding for the 4th year. But then you have 5 million of decrease in the liability. And therefore, your carrying amount of the liability at the end of the 4th year will only be 7.16. Let me clear this. And the last of this is that how the revaluation surplus will look like. First time revaluation is done at the end of year number 3. You have a credit of this much, and then you have a decrease of 9 million. You still have 6.58 million still in the revaluation surplus carried for this particular item of asset. This is what I wanted to cover for this particular video. This completes our series on the treatment of the changes in decommissioning liability, how to deal with it. You have my social media contacts here. Please feel free to connect with me. Please subscribe to my YouTube channel. Put comments in case what do you think about the videos, whether it is helpful, is something which you are able to use in your practical or day-to-day life, or even for your academic purposes if you are a student. Okay, and whether any specific topic you want me to cover in future videos. I will put my best foot forward to make sure that I include videos on those topics which are of use for the public at large. Okay, thank you. This is what I wanted to cover, and take care. Bye for now.